Welcome to today's lesson on insider trading. Many people believe all insider trading is illegal, but that's actually not true. There are both legal and illegal versions of insider trading, and understanding the difference is crucial for anyone interested in investing or working in finance. Today, you'll learn exactly what separates permitted insider transactions from criminal activity. Insider trading refers to buying or selling securities based on material non-public information about a company. Material information means anything that could significantly affect a company's stock price, like upcoming earnings, mergers, or major business decisions. Non-public means this information hasn't been released to the general public yet. The people with access to this information are typically company executives, board members, or others with privileged positions. The key factor that determines legality is how and when this information is used. Legal insider trading happens when company insiders follow proper procedures. First, they must disclose their trades by filing required forms with regulators before or shortly after trading. This creates public transparency, so everyone in the market can see what insiders are doing. Second, insiders typically trade during permitted windows, which are specific time periods when trading is allowed, usually after earnings are announced. Third, many executives use Rule 10b-5-1 plans, which are pre-planned trading schedules established months in advance. This removes any suspicion of using fresh, confidential information. Here's how legal insider trading works in practice. Imagine a chief executive officer decides to sell some company shares to diversify their personal portfolio. First, they establish a pre-planned trading schedule several months ahead of time, specifying exactly when and how many shares they'll sell. Second, within 2 business days of executing the trade, they file Form 4 with the Securities and Exchange Commission. Third, this filing becomes publicly available, so investors, analysts, and the media can all see the transaction. This transparency ensures the market remains fair and informed. Illegal insider trading is fundamentally different because it involves secrecy and unfair advantage. First, the person trades based on material non-public information that gives them an edge over regular investors. Second, they breach a fiduciary duty or violate confidentiality agreements by using this privileged information for personal gain. Third, they conceal their trades and fail to report them to regulators as required. Finally, this creates market manipulation because they're profiting from knowledge that other investors don't have access to, which undermines the integrity of financial markets. Let's look at a classic illegal insider trading scenario. A corporate executive learns through their position that their company is about to announce a major merger, which will likely boost the stock price significantly. Before this news becomes public, the executive buys large quantities of stock using this confidential information. They also share this tip with family members who purchase shares as well. Once the merger is publicly announced and the stock price jumps, they immediately sell their shares for substantial profit. This is clearly illegal because they exploited secret information that regular investors didn't have. The fundamental differences between legal and illegal insider trading come down to 3 factors. Transparency. Legal trades are disclosed to regulators and made public, while illegal trades are kept secret. Compliance. Legal trades follow trading windows, company policies, and regulatory requirements, while illegal trades violate fiduciary duties and securities laws. Market fairness. Legal trades allow the public to see and react to insider activity, while illegal trades create an unfair advantage where insiders profit at the expense of uninformed investors. Remember, transparency is the cornerstone that separates legal from illegal. Illegal insider trading charges can apply to many different people. Corporate insiders include officers, directors, and major shareholders who have direct access to confidential information. Professionals such as lawyers, investment bankers, and consultants who work with companies can also be charged if they misuse information they encounter. Tippies are people who receive insider tips from others and then trade on that information, even if they don't work for the company. Even government officials with access to confidential regulatory or policy information can face charges if they trade on it. Essentially, anyone who trades on material non-public information in violation of a duty can be prosecuted. The penalties for illegal insider trading are severe and designed to deter violations. Civil fines can reach up to 3 times the profit gained or loss avoided from the illegal trades. Criminal fines for individuals can go as high as $5 million. Perhaps most seriously, convicted individuals can face up to 20 years in federal prison. Beyond these legal penalties, those charged often lose their careers, professional licenses, and reputations. The government takes insider trading very seriously because it undermines investor confidence and market integrity. Let's review the essential points. First, not all insider trading is illegal. Transparency and proper disclosure make the crucial difference between legal and illegal activity. Second, legal insider trades require following regulatory requirements, filing appropriate forms, and respecting trading windows. Third, illegal insider trading involves using secret, material non-public information to gain unfair advantages over other investors. Finally, the consequences for illegal insider trading are extremely severe, including massive fines and potential imprisonment for up to 20 years. Understanding these distinctions helps protect both investors and market integrity.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.